I love hearing those stories. Thank you so much. Um, so Sarah, I understand your path because I've met many angel investors who have been in the startup world. They've made some money and then they want to help others. But I'm sure your path was slightly different than that. Can you talk a little bit about how you became
Nope, that's
an angel
exactly
investor?
my path. That was exactly it. Actually, what I found is that angels kind of come in two flavors. They come out of the entrepreneurial ranks, those of us who sort of are, say, employees 0 to 300 and end up being lucky enough to be at a startup that has a big enough liquidity event to create a sort of lump sum exit for early employees. The other group tends to come from people who are incredibly well paid at larger established companies, because you only actually have to make, I think it's 250,000 annually these days to become an angel. The angels come in those two flavors. And the reason why I call them flavors is because their investment focus tends to be pretty different. Their tolerances and interests are very different. Their expectations are very different. And knowing who you're talking to, whether you're talking to an entrepreneurial angel or a high net worth angel, is pretty important.
Thank you. That's helpful. Diana, when you and I talked the other day, it was great to get your background, your background in Wall Street, but I think it would be helpful for everybody to hear sort of how you became a venture investor.
Yeah, myself and my two partners, I think much like most women in VC these days, come from pretty non-traditional backgrounds. I'm not sure if you've seen the stats, but women in VC put out a great report that basically pointed that about 75% of women GPs have been, started in the last 5 years, and so they're all pretty new, heavily focused on kind of early stage. And so my path to venture, it started, I studied engineering, worked in tech investment banking at Lehman Brothers, and then commodities trading, and then left thinking I would never touch finance or tech again, because I thought it was absolutely terrible. And so it's kind of ironic that here I am about 20 years later. I started a company with another co-founder, and then we quickly pivoted to kind of an incubator model for female founders called Monarch. We actually ended up exiting that to a Female Founder Alliance, so it's all very nice. And then it started my angel journey about 7 years ago. So I angel invest on the side, especially if it doesn't fit our fund. And I met my two founders here in Houston. We were really looking for community around investors and founders. It's not as built out as it is in other ecosystems in New York City and the West Coast. And so we started building out the ecosystem of female investors and really looking for female founders here. And I really thought, I applaud you, Sarah, for, continuing to angel invest, because it is, very just, I find it's really hard to sometimes align, the amount of time you want to spend with companies with the checks that you're writing them and the kind of information you want back. And so I think kind of for us, it made sense to really think about how do we amplify the amount of capital that we want to give to these founders, and really jumpstart their kind of journeys into really high growth.
That's really helpful. Thank you. So the difference between the two, obviously, is Sarah as an angel investor is coming in early and financing, and as well, Diana, through your firm, you're coming in early, but maybe not at the as early a stage. But we can go into that a little bit more in our conversations. Let's stay with you, Diana. There's a host of questions in here, but like, what are you looking for in investments? Like, what attributes do you look for in founders and co-founders? And we can go from there.
Great, yeah. Outside of being female founded or co-founded, we look for companies where the founders are full-time working on their companies. While we like to meet them earlier, where the point of where we make a check investment is post-revenue, post-product, and post team in place, and that could be the co-founders. We're a little non-traditional in that we're not always looking for serial entrepreneurs. I think, again, women sometimes come into these roles later in life after an amazing career in whatever it is that they're going to build. And so I find that most of our founders have expertise in the product or or customers that they're building for, but not necessarily this might be their first, venture. And we actually like that. We look for teams that really want to work with us closely. And again, we're not a passive investor. We sit on boards on, I think, 95% of our deals, or, board observers. And so for us, it's really, does somebody want a partnership that we can help them get kind of through their A and B? And then does it fit kind of our, thesis in terms of, is it in one of our verticals? Do we really believe in the market? And then we're more, I think, cognizant than some VCs and some angels on deal structure. And so we don't do safes, we don't do sort of, instruments like that. So for us, it's always either an equity round or a convertible note.
So Sarah, let's sort of differentiate between what it is that Diana does and where you come into play and what you look for in investments at your stage.
Yeah, so I think stage is always kind of the misnomer. So let me just start by clarifying that. Angels come in at a lot of stages. I have done all the way from pre-seed. I don't ever really do pre-product, but that's a personal choice. I've seen plenty of angels that'll invest in a PowerPoint. But anywhere from a pre-seed round, I've done a Series D, right? So stage is not really the differentiator. The big differentiator between an angel and an LP is whose money are you investing, and is it a hobby or a job, right? And the reason why I think that's really important for entrepreneurs to understand is the kinds of things that end up being really important to an angel can be very, very different than what's important to LP. And I think Diana just hinted at one of those, which is deal structure, right? Like safe notes and convertible notes and other sort of devices like that are much more common in early rounds. A lot of VCs prefer to get, and some angels, frankly, prefer to get to equity rounds very, very quickly because you understand what you're sitting on. But the bigger differentiator, it comes down to who are you accountable to, right? In terms of what deals you do, and do you stick to your thesis, and what are the exceptions to your thesis and things like that. I'm accountable to myself. It's my money. I made it. I can do something completely random that looks like nothing I've ever considered in my portfolio. And I'm not accountable to an LP to justify that investment decision. And fundamentally, that is the biggest difference between the two types of investments. The other thing that I think is less about the type of investor you're talking to than the stage of investment is what amount of due diligence and what amount of data are people expecting. At pre-seed, it's very different than what you're expecting at Series B or Series C. And that is not different depending on who you're talking to. So if you're out trying to raise a pre-seed, if you're talking to good angels, they're going to be looking for the same kinds of diligence that a good seed stage VC is going to be looking for.
That makes sense. Let's talk a little bit about what you like and don't like to see in the cap tables and how that might differ for a venture investor versus an angel investor, and some of the other issues about critical decision making and what helps an opportunity stand out.
Yeah, I'm not sure that's different either. I'll answer first and then have Diana add. Is anything screwy on a cap table is screwy on a cap table, right? So
right.
If the founder has a very, very small percentage, that's worrisome. If there's a founder or somebody who left that has a really large percentage, I want to understand that. Like if somebody walked away and they're no longer there and they're sitting on 25% of the company, it's like, what the hell happened there? I certainly question deals that raised a ton of money to get to product market fit, and the dilution has just been extraordinary. It's just it's not that the company's bad, it's just a harder deal to do as an investment. I actually care more about corporate structure in some ways than cap table, other than the big red flags on a cap table. If it's an LLC, I'm not doing the deal. If it's an S Corp, I'm not doing the deal. If you're not a C Corp, don't come try and raise money. I think those are the kinds of things that certainly, since most of my deals are seed or A, are the most important.
How about for you, Diana?
Yeah, I mean, I echo that. I think we won't invest in deals that are not C Corps, but you're welcome to come to us because we'll just make you convert at funding, which we've done on a lot of deals. And then I think for us, the only other thing we look for is, can this founder raise? And so who are the other, because, we're thinking about their long-term capital raising prospects. Who else can we bring to the table that would join the cap table now and in the future? We probably spend a lot of time on thinking about capital raising kind of down the line and kind of all future rounds, dilution to us, ownership, what percentage of the company can we have? For sure, we want the founder, in particular the female founder, to have a meaningful amount of the cap table, and sort of what does the ownership of the cap table mean for kind of how those other investors might have specific rights in kind of the round we're in, kind of the future rounds.
So when you are, obviously, if you're anything like me, you see a lot of deals. How are you sourcing your deals, Diana? How many do you see a year? How many do you invest in based on, that's the crazy number. How many do you invest in versus how many do you see? And what are some of the common reasons that you might pass on a deal? That's a lot of questions in one, but I think you can give a good picture.
Yeah, for sure. I mean, I think one of the things that Sarah brought up that's very similar for us is really knowing who your investor is. And so the quickest way to not look at a deal is if it just doesn't fit our thesis at all. And we do get some of those. And so just doing the diligence on your investors, whether they're angel or VCs, and our information is out there, like what we invest in and what we like. And so kind of, for us, the top of funnel is 3,000 companies a year. Half of that is inbound from our investors or founders or kind of network, and half of it is outbound sourcing. So we've got a view on the market or a subset, and we go out and find all the companies doing that and talk to them. And so that's sort of, I would say we do about 500 calls a year with new companies, and we make about 6 investments a year. So it does really filter down quite a bit. After that first sort of filter of, does it fit our thesis, our structure, the areas we're investing in? We might look at, again, market potential, team, and all of those other kind of pieces, but it gets a lot more granular after that.
Got it.
And so to stand out, I mean, I think for us, if it kind of fits a lot of our core, tenants, then we'll always take a call.
And what's the best way for a founder to approach your firm?
I mean, I posted our email. It's on our website. It's either one of the partners. You're always welcome to email us at company@theartemisfund.com, or, we've got a senior analyst. We've got a staff of 10 interns, sort of doing a lot of the front of, kind of if it's coming in cold. We spend a lot of time with making sure that we're giving at least as much, if not more, to anything that comes in cold, because we want to make sure that we're not just favoring our networks and that
Right.
We're getting diverse kind of companies, deal flow. We really think about, we want to make sure that we're getting all of the best companies. And so even if they come inbound from LinkedIn or if they're coming in through the website, we are always willing to set up a call if it fits our thesis. We don't give any extra credit if it kind of comes from one of our sources. We think that's really important. And what's really held a lot of female founders back is because they don't have these networks built into the typical networks that are built.
Yeah.
And same for diverse founders. We really look for diversity around our portfolio. We've got a third, Black and Latinx founders, a third immigrant founders. That's another sort of area of ours that we look for, and the third other.
Sarah, what about you? Are you looking at 3,000 deals a year?
No. In fact, actually, pre-pandemic, I was probably looking at I wasn't looking at them. I was touching 350 to 400 deals a year as a single person on a part-time basis. And I think that is kind of the clarity that led me to backing way off. When you start getting to that volume, it is a more than full-time job for a single person with no help. And I found that angels tend to go one way or the other from that. They either decide, I love being an investor, and they go become a VC. or they end up saying, no, actually I got in this because I love being an entrepreneur and I love baby startups and I want to help other people do what I did. And those of us who fall in that bucket almost always start backing off the number of angel deals and do something entrepreneurial, go part-time, and then get ad hoc. That's absolutely where I found myself. And so at this point, I probably look at maybe 50 to 60 deals a year. And I write very few checks. I've written very few checks in the last year and a half. I made a conscious effort last summer to invest in founders of color, like straight up just wrote checks to founders of color that I put out an open call because I thought it was really important to not only lean into the moment, but during the pandemic, it was such an opportunity for people to start something that I already had a very diverse portfolio and wanted to increase that. So I got to do things like that, but I am hoping to write no more than 4 checks this year. So I think it's that kind of pull back to entrepreneurialism and a hobby that you see tons and tons of angels. So I think it's really important as entrepreneurs to understand that you'll hear, oh, this person writes a lot of checks. Well, they wrote a lot of checks and you don't know what they're currently doing until you actually talk to them, and it changes. It has nothing to do with you, it has everything to do with their own stuff that's going on.
Yeah, their own portfolio and their interests. So I love what I heard you say, which is, you're an entrepreneur at heart and you like to be really engaged on that level. So that's very different than.
Yeah, and it turns out I don't actually like the work of being an investor. So.
Well, okay, so let's take the next step on that. You look at 50 deals, you get down, you've met somebody that's an interesting potential investee. What happens next? What's the process by which you fund a company? Like, what do you ask for in due diligence? What do you need in the data room? I know we talked earlier about the level based on the, where it is in terms of its timing, but if you could just walk our guests through that a little bit, I think it would be really helpful.
Yeah, I wish I could say it's more regimented than it actually is. I will be completely honest that I have my own pattern matching. I look for familiar traits in entrepreneurial leaders that I have worked with that have been successful. And that's a huge portion of it. The bigger portion for me has turned out to be having founders that really understand the business model they are in. The thing that will absolutely kill a deal is a great idea, a great market opportunity, and a bad go-to-market. The go-to-market is probably more important to me than any other sort of aspect of a business model, and having someone who can actually do the go-to-market, right? So if you tell me that you're in consumer and you're going to buy a bunch of Facebook ads, the first thing I'm going to ask you is, let me see the ads and who's doing it. And if you're outsourcing all of it, then I don't believe you. If you're doing SaaS and you don't have anybody who can sell, I don't believe you. Those are the kinds of things that I start looking for. And that is, my first thing is going to be the founder. And if we have chemistry and if I believe they've got the grit, because being an entrepreneur is unbelievably disappointing and hard. And it takes not only the grit to get through, but it takes the support systems and the ability to focus and prioritize through a very long period of time in order to sort of see a company through the early stage. And that's unbelievably hard. The second thing is go-to-market. So those are the first two things. And I triage out 90% of deals on one of those two. And so when I get to the last 10%, then it's like, okay, why me? Why do you want my money on the cap table? Are you looking for more than I can give? Then I'm not going to do the deal. Right? I'm not looking for a board seat. So if you're looking for that, that's not going to be me. If you want me to answer the phone occasionally, yeah, we could probably do that. So I start triaging on commitment level, and do I have anything to add?
I think that's important, knowing what your skill set is and how you can help the company move forward.
That's right.
Diana, how about you? Somebody comes to you, you've got a great potential investee. What happens in your process? How do you think about funding it? What's your due diligence? What do you want in the data room? And what do you expect to see in a company's data room?
Yeah. So on the data room, you know, a great data room is great, but we're also happy to help the company put one together. You know, we'll usually do an intro call. If we're interested, we bring it up in IC, our investment committee, which happens every week, but, you know, we're communicating kind of throughout. And then if there's interest, you know, from the three partners, somebody will take a second call, because we always need two partners to make a yes. Will likely kind of at that same time either already have done or can start doing market diligence. A lot of times we've already got a couple of sets of market, you know, research of areas and competitor analysis. And so that usually happens in tandem with us continuing to talk to the company. And then, I mean, we obviously look at the structure, you know, are we leading or co-leading? Are we following? And it really depends on those two, which kind of path it takes. If we're leading, you know, it's going to require us to probably help raise the rest of the capital, set the terms, so it might take a little bit longer. We'll usually start doing diligence on, you know, I'll run through their financials with them. Our partner, Leslie, who's a lawyer, will spend a lot of time looking at any sort of governance, legal structure. She really likes to see that really, you know, tied up, especially if they've got any contracts, patents, anything like that. Stephanie will spend a lot of time thinking about the operations of the business. So, you know, a lot of that sort of, how is it running? How is it set up? We, you know, think about go to market. We'll do customer interviews. We'll usually vet it with a lot of our advisors and investors. We'll start talking to other, and sort of like as it keeps going down the, you know, the pipeline, other investors in our network to see if we can create a syndicate for the company. And so a deal can take anywhere from a few weeks to a few months to really finalize. Depends on how much they're raising. And sometimes it's, you know, if we've met a company at the pre-seed and we've been tracking, it can go faster. And sort of they just end up hitting a lot of our kind of, you know, numbers and things that we've been watching. We look if the company can hire, and if they've got kind of a vision of what that team looks like. We really like people. All of our founders have, you know, and all of our, I would say, top performing founders have this incredible ability to find lieutenants to work under them that are the best in their field. And they're able to recruit those people pretty early on or upcoming for, you know, oftentimes a little bit the promise of a small amount of equity. And so that's really impressive. It's not, you know, necessarily like a need to have the first step, but, you know, the ones that know who they're going to hire once that money hits the bank, because I think founders really underestimate the time to market if you don't have the team in place. You know, you're not going to hit your revenue milestones or goals if, you know, if you don't have that idea of who's coming.
Right, particularly in this employment market too.
Yes.
It's really tough.
It takes 3 to 6 months on a, you know, on a good case to hire senior, because you're hiring those early employees. They're really important, and they're usually becoming almost co-founder kind of level in how much work they're doing. And so those are really tough to hire, and they're expensive these days. And so I think, you know, it's helped that things are going, you know, more distributed, but I think that's a big piece of kind of a company's success is, can they hire, and do they know the right types of people they need to hire?
Can I just say something about something that Diana just said that I think gets lost in these panels a lot, and it's so important. What she was talking about when she was talking about this ability of founders to hire is also about these founders' ability to storytell, right? And you see this in really doing that kind of recruiting. You have to tell the story of the vision of your company. It's the same skill you need to go raise money.
Absolutely.
So when you're good at it, when you can tell like some engineer that you haven't ever met before that what they're going to do there is the thing that they most want to do and get them to come, it's the same thing that hooks angels and hooks GPs into being part of your company as well. And that storytelling ability really separates out founders. The ones who are great at it, who can then back it up, do significantly better. It's a skill that's really worth working on.
That's Excellent point. You are always selling when you are a founder. You're selling to your employees, you're selling to your customers, and you're selling to your investors.
And even people who
Well
don't
said.
think they can sell, when you have a vision that you can transmit into others. And that's why I call it storytelling instead of just selling, because I think
Yep.
it really is about finding people who believe the story you're telling. And most VCs will tell you that, especially in the very early stages, that's what they're investing in. They're investing in your story.
Yep.
Because you don't have enough traction to prove it out. You don't have enough growth to prove it out. You definitely don't have enough revenue. That's growth stage, guys. Like the earlier stage, we're investing in vision.
Thank you. That is a wonderful point. Thanks for pointing that out. I think it might make sense to just take a step backwards and understand for the listeners to understand where the money that you're investing is coming from. I'm going to have a question for you, Sarah, in a second, because it's coming from you, obviously. But for Diana, can you talk a little bit about what a limited partner is, or an LP, and what dictates your investment thesis, who and how much you can invest in, and talk in general about venture capital fund economics, so we can get a big picture.
Yeah, and I think Sarah kind of alluded to it earlier about, who you have to respond to. And so for us, our money, outside of coming from a small portion of us, majority comes from what we call limited partners. And they are everything from individuals and high net worth, people like Jill, to family offices, to corporates. We've got law firms, and to banks, endowments, institutions as you get larger and larger. So we have quite a lot of people that we answer to in a similar fashion. And so that makes it equally much more important for us to be able to get information from our companies so that we can then give it back to our LPs. In terms of strategy, we still set the strategy, but we are selling our vision and our strategy to our limited partners. And so when we deviate, we have to really be careful around, is this a one-time deviation, or are we shifting our strategy? Because if we tell our investors that we're investing in seed and we end up investing in only pre-seed or only Series B, or only, late stage, then that shifts our story, and that might not bring them back into our subsequent funds. And so those are sort of, some of the things we have to think about. We do have some ownership constraints, so we can't own a certain portion of a company. And so as a company continues to raise, we've got a constraint on what percentage of, one company we have. Whereas, if I was an angel, I can put all of my eggs into one basket and hope that hits. We've got a certain ownership percentage that we have to hit, that we promise our LPs that we're targeting. And so, and again, we can deviate from that and explain those things away. But as it starts to become the norm, that's when I think you start to get into trouble.
Yeah, mission drift.
Right. It become a little bit, further away, and we have to be reactive to what's happening in the market. And so we've become reactive within the last few years as, rounds are getting bigger, valuations are getting larger. And so you have to think about kind of, where do you want to interplay? Is it investing earlier? And is it, writing larger checks to get your ownership up front? So you can deviate, but again, it's a lot less free and open. And again, much like Sarah, when I write angel checks, it's a lot more, fluid. I do a lot of consumer investing personally. We don't really do as much consumer product within the fund unless it's really late stage. But like as an angel, I'm able to invest in all the kind of CPG I want. And economics, people think when you raise a small fund that you're kind of rich, but you're really not. You're sort of, you have enough to deploy to investors, to companies, but as individuals, we make a small percentage on the money that's committed to the fund that we use to run the fund and to hire people. And then really where we make the money is when our companies, kick ass and exit, and we return the money to our investors. And then after that, we start to take what is typically 20% of all upside. But that is, I love that, Sarah was kind of self-aware and said, I don't want to be an investor, because my former co-founder and I, She similarly said, I don't want to be an investor. I don't want to go on this journey. I want to go back to being an entrepreneur and started a company. And I knew that, for the next 20 years, and that's what you're signing up for. If you're going to do a venture fund, it's 20 years, like minimum 10, but really, if you want to make it worth your while, it's 20. I'll be doing this for the next 20 years. This is sort of the last great thing I have found to do with my life. And hopefully by then I can, retire and maybe angel some more. But that's part of the kind of, each fund is 10 years at a minimum, and you're raising funds every 2 to 3 years.
Well, it's interesting when you and I were talking the other day, and in my experience, and you said this earlier, that there are not, most of the female founder funds are in their first generation, right? They're doing fund 1, and there's a few that are in fund 3, and but the sizes of the raises for these female focused funds, they're small relative to the,
opportunity.
And it's frustrating. We need more LPs, we need more venture funds, we need more angel investors. So Sarah, let's talk a little bit about you, since you don't have LPs. How do you decide how much you can invest in the rounds that you participate in? Is it like cash available, or is it more like, are you trying to have a portfolio with 10 names at all times or 20 names at all times? How do you think about it?
Yeah, it's an interesting question. I have a portfolio right now of like direct investments over 50. So I've done over 50 angel deals. And that's not including the ones that have exited. I also LP in, I was trying to think about it while Diana was answering. Directed LP, I think I'm in 8 funds, right? And then I have sort of a whole different set of investments. And when I sort of look at it as a portfolio, it's not about percentages. For me, it's not about percentage ownership. I don't have minimums. I don't have maximums. I have what I call look-see checks. My look-see checks run around 25K, and it's what I call the catnip companies, the ones that I just can't not write the check. Sometimes it's the market, sometimes it's the founder. They tend to be a little bit more random. I don't do a lot of them. My sweet spot is probably 50, because those checks at the stage that I go in are first checks. Sometimes they have follow-on checks at the next level. Usually a 50K check at the earliest stage will give me enough to know whether or not I want to do a second check. If I write a 100K check, I have a 100K jinx. So every time I've written a 100K check, with 2 exceptions, it has been a nightmare deal. So I've now kind of avoided that. I will write random numbers rather than write 100K. The thing that I will say is that the total that I'm interested in having is almost always sub 1% of the company. Like, I'm just not interested in being most of the VCs that I work with or sit on boards with, they're targeting somewhere between 20 and 25% in those first rounds, because they know they're going to get diluted. I know I'm going to get diluted, and having 0.25% on a company that exited $1 billion is still a really great exit for a 25K check. And what I'm looking for are not the 2x returns. I'm looking for the 100x returns. So part of it is that the kinds of deals that I'm looking at are the ones that I actually think have a $1 billion story.
Right. And so the odds that, I mean, there's
the odds that I fail are very high. So I expect fully 60% of my deals to go to 0 within 2 years.
That's what I was waiting for somebody to say. Yeah. So this is the throwing the dice, and this, that 1 out of 10 might make it. You might.
Yeah, you hope for 1 out of 20 to be stellar, 3 to 4 to be a multiple, a couple to return the money, and everything else goes to 0.
Right. I want to make sure that I hear from the audience, but I just want to say, Rory, I'm having trouble seeing anything in the chat box, so I'm going to ask you to chime in if you have questions, if you're seeing any questions. But in the meantime, I can ask one last question of you ladies, which is any additional advice you have for the entrepreneurs that are on the call today? Why don't you start, Sarah?
The biggest piece of advice that I tend to give entrepreneurs is understand the interests of the person you're talking to. Not all VCs have the same issues or things that they're looking for. Angels are even more heterogeneous in this area. Like some really care about their ROI, some care about their portfolio, some care about the sort of sector, right? Like clean tech angels are really interested in clean tech. You have to know that, because what you most want is not to present your deck and read your deck. You want to have a conversation. You want to hook the person across the table. And if you don't understand why they're in the room, then they're never really going to understand why you're in the room. And I just think it's incredibly important to think about it as a conversation instead of a sales. I use the analogy, this is biz dev, it's relationship building. You are not coming in and selling this and walking away with a 25 to 100K check. You are coming in and developing a relationship with somebody who has the opportunity to put their money somewhere else, and they're going to give it to you instead. I think it's really an important focus.
Excellent advice. Thank you. Diana?
Yeah, I mean, I think it's similar, and it echoes. I know how, and I do the same thing because we are in the founder seed fundraising. The more research, diligence, and questions you can ask, and that's something you should come into every meeting if you end up getting the meeting, is spend as much of that time asking questions. But like with Sarah, you should be asking, how many checks are you writing a year? What are you looking for? What's missing, in your portfolio? Because, more so even for us, we won't do competitive deals that are competitive to our portfolio. And so, while we'll always take a call because we are interested, you should know that likely, we've got a plant-based milk company, we're not going to do another one. Or, if we've got like a 529 college, we probably won't do another one because we sit on boards and we really can't have, those types of deals inside. But we will always take a call because we're always interested in what's happening in the market. Could we make partnerships happen? So I think it's just doing the work up front really does save time down the road for everyone.
For everyone, yeah. I would voice that as well, to know who your audience is that you're talking to, not waste your time and their time, because time is very precious for you as founders. Rory, I don't know if you can help me on the questions.
I'm here. I got you.
Okay, thank you.
And founders, go ahead and put some additional questions in the chat, and I'm going to read them out loud and help facilitate some Q&A here. So one thing that was asked earlier is about kind of the dynamics around leading rounds versus not leading rounds, and what motivates investors to take different roles in the company. And I think this was slightly more directed at you, Diana, but Sarah, you have such depth of experience in the space that'd be great to hear from both of you on, what motivates somebody to lead a round versus not, or take a board seat versus not.
Yeah, and I think it really goes down to what your business model as a fund is. For us, and that's something again to vet when you're leading your funds. For us, our business model is a very concentrated portfolio, so that we expect, for us, it's definitely not 60% loss in 2 years is, what we expect and what we're seeing. And that means we're spending a lot more time. And so it's capacity. And so you think about, we've got 3 partners, what's our capacity for our companies? It's the story that we tell to our investors, in part because we think that our founders, in order to be successful, need that extra help. I think, female founders face these barriers at every stage of the way, whether it's, pre-seed or seed or series A or B, because there are no funds focusing in the later stages on women. We find that we are involved, with our companies at the A and at the B, really helping them fundraise. And so for us, the only way for us to ensure their success is to spend more time with them. And that means we're likely, taking board seats, leading or not leading. It's a lot of work to lead and co-lead rounds. That's the other kind of thing. It's a lot of legal, it's a lot of paperwork, a lot of back and forth. And so a lot of funds that have a more broad kind of portfolio approach will not lead. They won't set terms because it's just too much. Even though they might have a bigger check, it's just too time consuming. For us, again, our aim is to stay within our companies as much as we can, whether it's through the fund or through our SPVs that we launch. And so, we want to be partners, and that's just our business model. It doesn't mean that that's everybody's business model.
Yeah, I'll just add a couple of notes on that. Don't let someone lead your round who's never helped a company raise the next round. The most important thing when you add a VC to your cap table is that they help you get to the next round and they open those doors for you. Angels are kind of useful in that sometimes, and mostly useless, right? So angels are not great at helping you raise the next round. It's not really their role. Some of them have phenomenal relationships with VCs. Some of them will not use those relationships on your behalf unless you are the star of their portfolio, right? So it's not a guarantee that because they've got good connections, those are going to open up for you. And especially with the much broader risk that they're taking. Angels who offer to lead rounds and set terms, again, make sure that this is someone who really knows what they're doing. There's lots of angels who write like, a check a year and call themselves an angel. And they have a portfolio of 5 or 6 companies. That is not someone who should be leading around. They're not current enough, and terms change every couple of years. The valuation targets change, the amount of cash, the percentages, all of those things change. You've got to have people who are on top of that.
That's an excellent point. Thank you for that, Sarah. How are we doing, Rory, on time?
I think we have maybe time for one more question. And I was just kind of combing through, I've got some DMs here and some group chats. I think there's something really interesting that I want to hear your 2 perspectives on, because you see so many companies and have seen what's happening in this space over the last couple of years. Diana, you kind of alluded to this, that valuations are going up, rounds are getting a little bigger. I think at the same time, there are probably some founders in the room who are having this experience of seeing a lot of other people raise these big rounds, but they themselves are not succeeding. And there seems to be sort of this like potentially divergent experience. So I'm curious to hear, I guess, a little commentary on what you're noticing about the space from a valuation and round size standpoint. And how do you think that's affecting women founders, in contrast to some other founders out there?
Yeah, I mean, I've seen rounds at like $100 million. I mean, it's insane.
It's crazy.
We definitely stay disciplined with like some outlier. I think female founders are benefiting in that their rounds are also going up, but maybe not at the pace of their kind of the male founded companies. So I still see that there's a slight disparity. We're seeing all this data come out around how female founders are raising more in record numbers, but then the pie is getting bigger. And so they're not necessarily keeping up with kind of those statistics. I think as we start to see more female investors, whether they're angels or funds, like Graham Walker, like ourselves, like others, start to continue to raise, we're seeing more GPs, and that's going to help, I think, with the female founder side of things. On the flip side, yes, it's easier than ever to start a company. And so I think there's just while there is a lot of dollars, there's still a lot of competition out there, and just really being introspective around, again, who you should be targeting at what stage is really important, because I think that will help lead to that kind of success piece. I mean, a lot of founders, the problem is that they think that it's like the only idea that's out there that's doing this. And like, they have to realize that VCs or angels are seeing hundreds of deals. And most of the time, like, I can go into our database and find 20 companies doing the exact same thing. And kind of, in slightly different ways, or sometimes not so different ways. And so it's just thinking about like, what is the competitor analysis? Am I actually offering something unique and with a unique point of view on the market?
Sarah, what are you noticing, and any closing
wise
thoughts?
I have no data to back this up. It is anecdotal at best. I think that the valuation surge that has been going on for the last little while has also matched sort of the metrics at which those valuations are happening, also surging. So it's just retitling rounds. So seed is what A used to be. A is what B used to be. The kinds of metrics and expectations, and like whether you're investing at product market fit, or are you investing at revenue and go to market fit, or are you investing in growth? Like, it's just shifted a little bit. Pre-seed, now you see people doing 3 rounds of pre-seed, where they used to do a single angel round. It's just breaking it up to do it. And you're raising more money, there's more dilution. I actually think first-time founders, atypical founders, including female founders, including founders of color, are basically have been screwed in this valuation jump. And this is why I say it's anecdotal. I don't have a huge amount of data, but when I have looked at the deals that are coming through, when I look at the deals going to the angel groups that I'm part of, when I look at the referrals that I am getting, there are fewer first-time founders, there are fewer women, and there are fewer founders of color coming in those. And they are looking more and more the same, because one of the things that is very true is that as the later stage venture capital starts chasing the different types of companies, so that everybody has a SaaS company that does this, or a consumer company that does that. And when I say consumer, by the way, I'm talking consumer software, not CPG. That's a whole nother ball of wax. But as they're chasing that, you see the quote unquote pattern matching algorithms coming into play, and people going for people they know, people who look like people they know.
Right.
And that always screws the people who don't look like that.
Excellent point. Excellent point. This has been an incredible conversation. Thank you both, Sarah and Diana, for your insights. And thank you to all of you incredible founders for being brave, for going out there, for doing what you do so well. We hope that you feel supported by today and look forward to supporting you in the future. Rory, I'm going to turn it back over to you.
Wonderful. Thank you, Jill. Thank you, Sarah. Thank you, Diana. You have lots of praise coming in the chat. Really insightful conversation. Thank you for being here with us today.